Okay, I'm unmuted, which is fantastic. So thank you for joining us this evening. I'm Robert Stringer, and I'm here with Richard Mann to talk to you tonight about investing in these uncertain times and future-proofing your investment strategy. As with our last webinar, I just mentioned that we're recording this one so we can share it on the website. And we're delighted to be joined by Darren Johnson, who's Head of Engagement at Investment Consultancy from St James's Place. We're really honoured to have Darren with us. He has responsibility for all face-to-face contacts between the investment division, us, the partners and clients. And he describes the role of him and his team as taking technical market information from the market analysts and translating it into something more interesting and relatable to investors. I'm sure he'll explain that a bit more, but we probably wouldn't understand it if it came straight from those analysts. Darren's going to take 10 minutes or so to go through some slides and talk about what's going on, what's been going on, and then we can head into Q&As. So we hope, because it's such a beautiful evening, we don't want to keep any of us or any of you for longer than we'd need to, but it will be driven by your questions. If you wanted to put something in the chat, that's fine. Also, there's the raise your hand thing. That's very useful because we can see that if you do raise your hand by pressing the reaction, the raise your hand. And I think Darren will be really happy if you need to respond as this is going along. So please feel free to do that. We're a reasonably small group tonight, so it's not going to be too much. So I'm going to hand over to Darren and speak to you later.
Thank you, Robert, and thank you to everyone for joining this evening, especially given the weather and the football being on. Look, I'm just going to spend 10-15 minutes at the start talking about not everything that's going on in the world, but to sort of lay the base ground of how we view long-term investing, how we see where we are at the moment, and really try and provide some comfort that despite the negative media, despite everything and the tragedies that have been going on, most of the time, the investment side is quite a simple thing, which is, and doesn't tend to change. These things tend to happen in cycles. This doesn't look a great deal different. I'll put that into context with a few visuals. And then what we'll do afterwards, hopefully through the Q&A section, is to deep dive into anything that is of concern to you. We'll talk about inflation, we'll talk about vaccinations if you want, we'll talk about the road to recovery, how we pay for everything. This can go anywhere you want it to go in the next 45 minutes, and I would rather you leave here with your questions answered rather than having more questions raised as a result of this. This is for clarity and comfort mainly. Just the first, I always try and start these presentations with a quote, and this is the one I've chosen for this evening. In financial markets, hindsight is forever 20/20, but foresight is legally blind. And thus, for most investors, market timing is a practical and emotional impossibility. Now, the reason I'm saying this is because if we all managed money via hindsight, i.e. what has happened, and we judge accordingly, all of us would be retired by the time we were 25. It would be as simple as, if markets go up, you invest. If markets go down, you get out. Well, unfortunately, that just isn't possible. Hindsight is 20/20. No one ever gets a thing wrong. And we are in the game of trying to predict the future, essentially. And you know, most of the time we will say, we don't know. Now, there should be a lot of comfort, strangely enough, in saying I don't know. The ones that we often find, or we are often most cynical about, are the ones who say categorically that they know what's going to happen further down the line, because firstly, we've never met anyone who can consistently do that. So therefore, and also it only takes once to be wrong. If you're putting all of your eggs in one basket and you're wrong once, that's it, you're back to square one. And you know, whichever stage of the investment horizon you're on, whether you've got 5, 10, 15, 20 years left, or even more, going back to square one is wasted time. And therefore, often the diversification argument, the long-term argument, is always the one that people go back to, because it's the one that often plodding along is what people end up wanting to do. And yet there are times of euphoria, there are times of disaster, etc. And on this slide here, this is, I'm increasingly fascinated by this. I go away from it and then the market does something and then I have to keep going back to it. And I've probably done that for the last 5 years. I've been at St. James's Place 15 years now. I've been using this, it must be 5-6 years. And it never fails to throw up real life examples of how people feel and how people react. So the theory behind this is that there are only really two valuations that a client or an investor will look at and judge an investment by. Now, that isn't how much they invested originally and how much it's worth today. It's usually, and this is the real life immediate reaction, it's the valuation today compared against the last time you looked. So if I was in front of everybody now, I would make everyone put their hand up and I would ask the question, how many of you think you look at your valuations too often? And I, as an investor, I would put my hand up on that. Now, as an investor, the psychological theory behind investing is the more often you look, the more emotional you get towards that investment. The more emotional you get towards that investment, the less rational your decision-making becomes. So if you are an investor who looks every day, and of course, it's your money, you can look every day. Technology is such now that you can look every day. The most I've ever had actually is somebody said, I look twice a day. So bearing in mind it only changes once a day, I think that's a bit overboard. But if there's comfort in making sure that it's the same as it was this morning, absolutely go for it. But this really just emphasizes the amount of emotion that people lay within their own money. Now, of course, I can talk about markets in a percentage term. And as a percentage term, you can put it into rational conversation. To you, your money is pounds and pence. And the more money that you've got, the more pounds and pence that will be to each percentage point. So I can say, well, it's only 10%. But think about what 10% means to you in pounds and pence. And so to the investor, of course, you're going to have more emotion attached to that. As a fund manager or as an investor, as a portfolio constructor within St. James's Place, we are one step removed from the emotion and hopefully can make more rational decisions on your behalf so that you're not going through the cycle that you see on screen. Now, the cycle you see on screen is that on the left, when markets go up, you feel optimistic, you feel excited, you feel thrilled. I can, with great confidence, say that you're more likely to invest at that point. People are more likely to invest when they're confident. You are more confident when your money's already gone up. But unfortunately, that's the point of maximum risk. So think about how you felt last January, last February, for example, when markets were near all-time highs, if not at all-time highs. And then on the way down, you feel fear, you feel desperation, you feel panic. And remember, if you're looking every day, you're feeling that every day. It builds, it compounds, it snowballs. Now think about how you felt in March last year when markets had fallen 35% in about 6 weeks. It was the sharpest downturn the quickest downturn in history and the steepest economic decline in history. Think about how you felt at that time, the emotion that was attached to that. And of course, you had that with you were worrying about people's health, your family's health, jobs, everything. People were worried about everything, and markets and people's investments were just compounding that as well. So people were feeling these things during that time period. Now I can say to you that whichever time period you look through, this is exactly the same. This isn't a COVID chart. This is, you can put the banking crisis on here, you can put 9/11 on here, you can put the OPEC oil crisis down here in the 70s. This is how people reacted. More likely to invest at the top, less likely to invest at the bottom. Now, if we really simplified this and I asked you what you actually want your fund manager to do, most of you would say buy low, sell high. That's the cliche. Now, the emotional chart is the exact opposite of that. So by stripping emotion out of it, by having someone invest who's 1 or 2 steps removed from the emotional side of the decision-making process, you are able to make more rational decisions and more chance of buying low and selling high, as simplistic as that sounds. And equity is the only thing that actually reacts this way. Most people on here, I'm sure, will have negotiated on a house price, a house in their time. The more expensive a house gets, if you're negotiating, the less attractive that asset becomes. Yet the more expensive that an equity becomes, the more attractive it becomes to the wider market. On the flip side, if you're negotiating with a seller of a property and they say, I'm going to knock 10% off this for no reason, just because I have to sell it, you're more likely to buy that house. It's more likely to sell. If equity markets fall 10% for no reason, what does the market do? runs for the hills. And it's a very strange scenario where the more expensive it gets, the more attractive it gets. There's no other asset really that we can find where people rationally make that decision. And I always point to the January sales, where something can be 20% cheaper than it was 3 weeks ago, and people are queuing around the block for it. But it's the same tats that they didn't want before Christmas, but suddenly they're queuing around the block at 5 o'clock next because it's open, and they can get things 20, 30% off. The cheaper that something is, the more attractive it is to a fund manager. Not to, strangely enough though, not to a private investor. So always think about it's perfectly rational or perfectly understandable, to look at your investment, and if it goes down, feel emotional about it. Absolutely it is. But it's not necessarily the time to be making decisions about what to buy, what to sell. That's somebody, we genuinely think that more rational decisions are made by someone who is 1 or 2 steps removed from it being their money, if that makes sense. And it also looks at, the more often that you look at your investment, the more emotion you'll feel about it. We can also put that into the context of, depending on the lens that you look at it, the more often you look, the more likely your objectivity is to be skewed away from the reality. So if you've come on here for market predictions, unfortunately, I'm not going to give that, because if somebody is going to ask me where the FTSE is going to end the year, I will say I don't know. What I can say to you though is that on any given year, you've probably got marginally more chance of a positive year than a negative year. But what you see on screen right now, hopefully you can make this out, is a rolling 1-year return of the FTSE All Share. Now, that is the UK market over the last 25 years, showing you on a 12-month basis the range of returns that you could have got. So if somebody says to me, what am I likely to get over the next 12 months? I will say to you, it's likely to be within a range of +60 and -40. And you all have wondered why on earth you turned up for such insight. But this is why we don't make decisions based on a 1-year time horizon. If you're speaking to Robert or Richard and you're saying, I've only got 1 year left until I need this money, this is exactly why you will not be exposed, or you're unlikely to be exposed to equity markets, because the range of returns is so vast that you could be lucky and you could be unlucky. But we're trying to strip luck out of it. It is our job to get luck out of this and put it in skill, judgment, and rational decision making. Now, if I go to the next slide, which is the 10-year return, that is exactly the same market, but through a different lens. That is looking at the rolling 10-year return. So if you said to me what a market's going to do in the next 10 years, I can say to you, the likelihood is it's between +16% per year, remember, compounded, or +5. Now, +5 doesn't look too bad to most people at the moment, +5 per year, given everything that's going on. But that's the range of returns in the same market as I showed you before. But if you overlay them both together, that's the same market, but just viewed through a different lens. And if I said to most people, which investment timeline would you prefer? Which investment experience would you prefer? How would you sleep at night during these? Most people would go, I want the red one. And yet it's exactly the same investment. But one will be judged one way and one will be judged another way, because one is being looked at more often than the other one. Now, we're not saying don't look at your valuations. We're just holding a mirror up and saying, this is what can happen. And this is how your view can change from one day to the next, from 1 week to the next, etc. So having a consistent plan throughout your long-term time horizon makes complete sense, because our view is market cycles will come and go. And the longer you invest for, the more cycles you'll go through. So to emphasize this, we call this watch the tide, not the waves. Coronavirus and the impact of coronavirus is on the right. But you'll see everything on here was the biggest deal in the world at the time. You've got 9/11, you've got the banking crisis, the first Gulf War, Black Monday, OPEC, going back to the 70s there. A market fall of this size is not new. It's not comfortable, but it's not new. The likelihood over a 15 or 12 or 10, 12, 15 year period is the longer you invest for, the more chance you've got of positive returns. The FTSE has never underperformed cash over a 12-year period. So the longer you invest for, the more likelihood you are to be invested in equities, because the biggest probability of success is in equities. So the theory behind this chart is markets grow because economies grow, and economies grow because people spend more money. So if people spend more money, economies grow, and economies grow, the markets grow. So given the fact of where we are, and we can get into this in the Q&A section, given we should hopefully be in a stage of recovery at some point over the coming years, you would expect people to spend more money. You would expect economies to grow, and therefore you would expect markets to grow. So wherever your money is at the moment, our view is to be exposed, hopefully, if you've got a long enough time horizon and a sufficient risk profile, to areas that are growth areas over the coming years. It's our job to find those growth areas. It's also our job when the worst happens to protect those assets as much as we can, because the less they go down in the first place, the less hard work it is to get back to where you were. Now that sounds obvious, but I can tell you that obvious and common sense tends to go out of the window when volatility hits and when chaos occurs. And I don't think we've ever seen anything quite as chaotic as what the world was going through at this time 15 months ago. And it's just bit by bit by bit. And yeah, I like this chart or this graphic because quite simply, again, the longer you invest for, you find that actually you don't quite realize how much your money has grown or how much it's growing, because Einstein said compound interest is the eighth wonder of the world. 2% on 2% on 2% on 2%. By year 13, year 14, year 15, that's not 2%. That's 2% on your original money and then all of the growth as well, which is why it takes 10 years at 7% is doubling your money. It's not 70%, it's doubling your money. And actually, the compound interest, the longer you invest, the more your money's worth, the more that growth ticks up, ticks up, ticks up. And it's massive improvement over that time. But we still get a lot of confusion over why, when we're still going through this tragedy, our market's going up. And I'd just like to spend some time on just explaining that, because I think it's worthwhile. This quote here from Jeremy Grantham: the market does not turn when it sees the light at the end of the tunnel. It turns when it all looks black, but just a subtle shade less black than the day before. The market bottom in the UK was the 24th of March, 2020. It was the day after Boris had announced lockdown 1. Now, if you think about what it felt like at that time, think about what the news was, think about what people's employment possibilities were, think about what we knew about the virus. Pretty much nothing. We didn't know when things would get better. I think it was 3 weeks to flatten the curve at that point, wasn't it? But ultimately that hasn't happened, but it shows how uncertain the world was. So the market had said, this is as bad as it can get. Now think about where the world's got to. Of course, we would all like to have gone quicker. Think about where we've got to in the last 15 months. That's why the market has got to where it is. Are we out of the woods? No. Is there a long way to go? Yes. Will there be bumps in the road? Probably. But ultimately, the market goes up when it looked a subtle shade less black than the day before. And March last year was dark. We didn't know what the numbers were going to be. And of course, those tragedies came through. But the market had priced those in before. And that's why I think some people feel slightly uncomfortable with making money during something like this. And absolutely, we understand that. But this is what I'm trying to explain here, is why the market has gone up during a period where the economy is in trouble, employment numbers are in trouble, health is in trouble, et cetera, et cetera. But that's why, is because the market had priced in absolute disaster at March last year and then slowly ticked up before. It hasn't rocketed up, it's slowly ticked up. And this is really where I say tick, 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 tick. And all of a sudden you look back and you go, how on earth has the market gone up 50, 60% in a year? Well, it's because it's just marginal gains that added up to that and compounded upwards. Now, where vaccines are currently, I think I'm going to take you back to November the 9th, 2020, which is now called in Fund Manager land Vaccine Monday, which I don't quite like. But that was when Pfizer announced their phase 4 trial had been successful. So before that, it was dark. Pfizer announced on November the 9th that they tested tested it on 43,000 people across 23 countries. All of a sudden, a vaccine was a possibility. Now, I stress this for a couple of reasons. One is we're only about 8 months away from that. That feels a lifetime ago. And I think what we're at now, 73 million doses. I'm often accused of not being the most optimistic chap in the world and one of the most cynical. But that will be looked back on as a marvel, almost a scientific miracle. That within a year you could have, within a year of lockdown, you could have so many people vaccinated. Within 15 months of lockdown, 73 million doses. Will July the 19th happen? We don't know. but ultimately you can see how the market has priced in progress. And in this world, everyone wants everything immediately. We get that. Markets don't tend to work that way. And actually, again, the longer you leave it, the more likelihood of there is of this tick, tick, tick until you get to that gain, that larger gain at the end. On the screen here, you see what the market did that afternoon after Pfizer had made that announcement. Travel, airlines, hotels, pharmaceuticals, unsurprisingly, really gained quite substantially as a result of, well, the world might get back to some sort of normality. Now, it's not saying when, it's just saying it will. And I think that's why all of us look at the vaccine program and say, okay, if we are saying okay to the jabs, that's why we're saying okay to the jabs, to get to the point where we can get back to some sort of normality. So the market suggested immediately things are going to get better. We don't know when. We don't know when we're going to get to the end of the tunnel, but there is light at the end of the tunnel. On the flip side, all the companies that it seemed to benefit being in lockdown all seem to go down at the same time. So Netflix, if Netflix could have designed a set of circumstances to benefit Netflix, it would have been March last year. Everyone's locked up in their house. No one wants to watch the news anymore because there's nothing else going on. Let's get Netflix on. Now, Disney Plus launched at that time as well, which I'm deeply cynical of, that they managed to time that to the exact day. But still, Disney benefited from it. But Netflix went down 8% in an afternoon. Zoom. Now, I appreciate the irony of saying this while we're all on a Zoom meeting. Yeah. 18 months ago, who'd have thought that this would have happened? And yet it benefited Zoom. That went down 17% in one afternoon. And Peloton, which I always joke I should have heard of, it's a home fitness app. I should have heard of it long before I did. But ultimately, everyone was working out at home because the gyms weren't open. Now, of course, if everyone goes back to some sort of normality, there are winners and losers in that. Hotels, restaurants, airlines, etc., will benefit from that. On the flip side, maybe it doesn't benefit these technology stocks that quite simply had their set of circumstances that they couldn't really fail within. And I'm just going to use my last slide to point out this, because while I'm on about the technology stocks, and I'm just going to, hopefully you can all see the screen here. I'm just going to play a little game that you can just make a mental note to yourself when I take you through this. Often, if everyone's on screen, I can gauge how old people are by when they start nodding. So Robert, Richard, and Alison, I can only see you. So when you start nodding, I'm going to judge how old you are on this, okay? So I'm going to take you through the various decades. Now, what you see on screen is 1980. None of you are nodding yet, so okay. Right, 1980, these are the top 10 companies in the world. So the top 10 companies in the world were dominated by oil companies at that time. Oil was at an all-time high. Oil was clean energy at that point. We were going to go through a period where oil was going to expand the global economy, et cetera, et cetera, et cetera. Now, if you'd have invested all of your money into the stock market at that time on a passive basis, 40% of your money would have gone into oil in 1980. I'm going to put up 1990, and I want you to make a mental note of how many companies that were in the top 10 in 1980 were in the top 10 in 1990. I'll give you 2 seconds. 2. Now, bear in mind, if you invest passively, it is the exact opposite of buy low, sell high. It's buy high, sell low, because as these companies get smaller, you sell your holdings. As companies get bigger, you replace the holdings that have gone down with the holdings that have gone up. It's entirely based on hindsight, which is what I started this presentation with. So in 1990, this was the peak of the Japanese boom. Japan would have made up 43% of your money at this point. Today, it would be 7%, which really tells you how that would have gone over the last 30 years. So in 1990, how many of these top 10 would have been in the top 10 in 2000? This is usually where somebody starts nodding. So 2000, this was the peak of what may be referred to as the first tech bubble, but let's say the tech bubble. So this was the top 10 companies in the world. Within the 10 years of this, you'll have gone through 9/11, First Gulf War, Enron, and the global financial crisis. Each of those on their own would have put markets down by 30%. And you had 4 in the space of 10 years. So again, if you'd have invested in this, you'd have had 40% in technology. In 2010, how many of these have made it through all those unscathed and been in the top 10 companies in the world? 3. Now, most of you will have said 2 because you thought you would have seen a pattern. No, it's 3. So I've caught you out there. ExxonMobil, which has been hanging around the whole time,
Yeah.
Microsoft, and Walmart. Now, this should be the easy one. At the start of 2020, how many of these top 10 in 2010 would have been in the top 10 in 2020? 2. So passive investments have their place. This isn't me on an active versus passive rant or anything like that. This is the danger of judging the market based on what is successful today rather than what is going to be successful in 10, 15, 20 years' time. I always say that you want to invest for what the world looks like when you want your money back. It is a fund manager's job to predict as best as they can what the world looks like in 2030, in 2040. It's hard. Of course it's hard. The easy suggestion is to invest in the biggest companies of today, but that is entirely hindsight based. Apple, Amazon, Google, Facebook, Netflix, they're astonishing companies, but they've had their growth. That's why they're the biggest companies in the world. So, but people tend to invest in them because they think that they can replicate the growth of the previous 15, 20 years. If Apple replicates the last 15 years, it will pretty much be bigger than most countries. So today, Apple is the 20th rich. So if Apple were a country, it would be the 20th richest country in the world. If Amazon it would be the 21st richest country in the world. So if we're suggesting that these companies get bigger than countries, then fair enough. But that feels like that's a stretch to put all of your money to invest into. So I'm going to conclude this here. I'm going to hand back control of this to Alison. And I think we're going into some Q&A, but hopefully that gives you some thinking points and just some context about how we see the long-term nature of investing and why we're not necessarily overreacting to short-term market movements.
Darren, thank you. That's absolutely brilliant. And those last slides there are astonishing, really. So with Exxon, and of course, then oil goes out of value, of course, from 2019 obviously onwards. So as we'll see, it will continue that way. Just amazing to see that. Actually, I haven't seen that before. Thank you. Does anyone have any questions that they would like to raise a hand, put in the chat to start us off? You mentioned a couple of things actually that I'd like to cover. One is how I sort of think I know the answer in terms of corporate bonds and gilts, but how do we repay this debt? I mean, what's the effect on that? And does SJP have we started buying gilts and things have they been released? And are we doing it? So that's one thing. And then the other thing I'm really interested in is, because I've read a lot about it and I'm worried about it, is the inflation. Yep. So I personally, having worked through the 80s and things, I know inflation erodes the value of debt, but obviously, what's the effect on the stock market? I know lots of clients have got money, and I know lots of businesses are doing well, but we've also got the problem with Asia and container ships all stuck around the world, not bringing stuff, which I'm worried about. That's an inflation. And what's the effect on the stock market? Because I keep saying I don't think it's always bad. So I'd like to know how we're going to pay the debt. What's the effect on us for doing that? And what about inflation?
Okay, so I'm going to deal with the first bit first of how we pay for this. And I very deliberately phrase it as how do we pay for this rather than how do governments pay for this. So you can probably tell where I'm going with this. Look, gilts are being issued constantly. They always were, always have been. That supply has gone up. The demand has also kept up with it. But it's going to have an effect on the price of those, or the yield you can get. I mean, if you were to invest your money now in a gilt over 10 years, you probably get about 1%. Well, this morning we were told inflation was 2.1, and I'll explain in a minute why I say we were told it was 2.1. Yeah, if the figure is 2.1 and gilts are 1%, then you're guaranteeing yourself a real loss over 10 years. Yeah, that means that investors have fewer options than they've had before, and the higher that inflation goes, the more you need to make sure that your bond yields are sufficient to keep up with inflation at least, and make a real return. Now, how do we pay for this? Look, the government has to do whatever it takes. This is an unforeseen circumstance. I'm not going to get political on this, but you would expect any chancellor to have done what was done. Yeah, that's just a given. And if you look around the world, it's being done pretty much. Maybe different amounts, but similar strategies. Particularly in the US, where $1.6 trillion. They've given people money. Every single person's received money into their accounts. They've just attacked it a slightly different way, but ultimately it's government debt and it needs paying. Now, they've got two options. I'm trying not to get cynical. They've got two options, Robert. One is taxes. Now, I appreciate this isn't a tax session, and nor am I a tax expert per se, but ultimately, I think it's inevitable that there'll be tax rises in certain areas. The government seems to be going down the route of who looking at tax rises that will annoy the least people or the fewest people. So again, trying not to be cynical about it. The autumn budget, the last budget. Income tax will be the obvious one, but if you raise income tax, you annoy everyone. If you annoy everyone, you're more likely to be voted out. That's my cynical view. If you go for CGT, it affects fewer people.
Yeah.
If you attack IHT, there are a lot of accidental IHT payers due to property prices, etc. So CGT seems to be the one that they've fallen on, and I think was it in the tens of thousands of people that it would affect. So you can actually go back to the population and say, we're all in this together, but we're going to attack this area here. They might be annoyed and they might grumble, but ultimately it doesn't really affect the voter base, etc., etc. Now, you can probably see where my view on politics and markets sort of overlap here, but I'm of the view that politicians will look at cycles in political terms. So 4 or 5 years as a rolling fit. So ultimately, someone investing for the longer term, the longer they invest for, the more political cycles they'll see, and the less important one political cycle goes. When you're looking at taxes now, of course, up, down, et cetera, I think at the moment it's about the most revenue for the least hassle. The more that debt goes up, the more people you're probably going to have to annoy. So I think I would always put it that until you know what the damage to the economy is, you don't know what the solution is. And I don't think until we know what the damage for the full damage is, and you'll see that the furlough scheme is talking about being extended. We don't know what the figures are going to be, so we don't know what the final debt's going to be, so we don't know what the final debt to be paid off is going to be. Now, the reason that inflation is so important, and I haven't quite worked out whether people oversimplify inflation or whether they overcomplicate it. It feels like people do both, which shouldn't be possible. On a simple basis, inflation benefits those who've borrowed money.
Yeah.
So any government or any central bank at the moment that is criticizing inflation seems to be sort of distracted from the fact that there's this massive debt mountain being built up day in, day out. Any mortgage holder for 25, 30 years will tell you that they're pretty pleased that inflation occurred.
Yeah.
Because you're paying back far less in real terms by the year 26, 27. I remember I always joke with my parents that their mortgage was about 10p a month. And yet, you don't realize it when you're going through it. But again, it's that compounding of inflation as well. Now, of course, if you're a saver, if you're an investor, inflation is more of an eroder of your capital rather than an eroder of your loan. So I think from a saving investment point of view, inflation is no more of a risk today for us than it always has been. Anyone who's ever received our risk reward documents will know that it is front and center as a risk to your money. Now, it just so happens that at the moment, it's the thing that the press and the financial press in particular is worried about.
Yeah.
And I always joke that the financial press can only worry about one thing at once. It's our job to navigate through all risks, not just the one that the press is worrying about at the moment. So has COVID finished? No. Has Brexit over with? No. And I apologize, it took 37 minutes to mention Brexit. I'm not going to mention it anymore. But that Brexit's still there. If I even go back even further, has Greece been sorted out? Has the Eurozone been sorted out? And we're going back to 2012 then. You could even argue, has the banking crisis been fully sorted out? And that's 2008. So all these things are still there, but it feels like when we're reading the press and when we're watching the news, that it's one thing after another. But actually, all these things are happening at the same time. So inflation is one risk, absolutely, that is front and center at the moment. It also made me laugh a bit that this morning we're jumping about 2.1%. And I spoke to a fund manager the other day that said inflation is everywhere apart from the official data. Now, the official data this morning told you it was 2.1%. Has anyone on here tried to book a UK holiday this year?
No.
You tell me that prices have gone up 2%. That's, it is everywhere. Is it a longer term thing? Maybe not, because you think it's just a reaction to where things are, and you'd expect UK holidays to go up because the demand is higher. Will that demand be there next year to go up again? Well, actually, if EasyJet are offering flights at 20 quid to Spain next year, probably people aren't going to spend £4,000 in Devon. This is almost the extremes we're at now. So this feels like a bit of a shorter term inflationary issue. Traditionally, in inflationary environments, consumer facing equities do well and property do well. Now, the thing that's not being talked about in the press is that there are still winners and losers from this. But it's being talked about as if everyone is a loser from this. Well, borrowers or mortgage holders are winners in this. Anyone in debt is a winner and is a loser in this. Was a winner in this. But consumer-facing equities. So what I mean, the easiest way to visualize this is think about your direct debit list. I don't know. Yeah, if you've got an Excel spreadsheet with your direct debit list on, that is generally the list of things that you will pay for, regardless of how much they cost. Your electric bill. If your electric bill goes up £3, are you going to suddenly say, I'm going to live without electricity? Your gas bill, your broadband, Netflix, Amazon Prime. These things are small amounts. Amazon Prime, $7.99. I always, that can go up £1. That's 12%. But $8.99 is not. Nobody's going to go, oh, I'll wait 3 days for a delivery then. It's just that's where we are. Is these smaller amounts, 10%, they can add 10% on, and they've got a captive audience. If you look through your direct debit list, these companies, that list of companies is generally going to get your money regardless. Sky pretty much add £1 on every 6 months. And it just gets to a point where you think, when on earth did this get to that point? Yeah. But it's inflation, but because it's direct debit, you don't tend to notice it because you're not shelling out the money every month. What inflation tends to hit, just to finish off the food, bread. If 10p goes on a loaf of bread, you're going to go, right, I'm not eating bread anymore, not eating milk anymore. Bread, milk, butter, all these different things are basics, almost not inflation proof, but Sainsbury's will say, we're going to add it on. So you're feeling the brunt of it. It's not Sainsbury's that feel the brunt of it. They don't absorb the inflationary costs of their suppliers. They pass it on to you. So ultimately, as long as they're still selling as much, and most of those basics they will, this is why we say consumer-facing equities tend to do okay in inflationary environments, because they don't bear the brunt of it. The consumer bears the brunt of it. And usually the consumer goes, oh, well, I've got no choice. On the flip side, non-consumer facing equity. So luxury goods, and if £1,000 goes onto the average price of a car, there's going to be fewer cars sold. If petrol goes up, you probably think, I'm going to work from home a bit more. People have got more options to do that nowadays. And so that feels that there will be winners and losers. The reason property is usually a winner in inflationary environments is because the tenancy agreements tend to be inflation linked.
True.
So regardless of how much inflation is, your rental income will still keep up with it. And the rental income is the majority of your return. So therefore, property tends to do better. Bonds, well, unfortunately, like I said, if you've got to make sure you're getting a 2.1% yield at least. So if that goes up to 3-4, that makes investing in bonds, you have to up the risk scale to chase the yield, which tends to mean that people come back to equities anyway.
Okay.
Because rather than chase the yield, but it's a constantly moving target. And like I said, inflation is everywhere but the official data. But this summer, you also have to take into account that inflation is a year-on-year measurement, and where we were last year is not normal times. So I
So our
think,
fund managers will, if they're thinking about it, well, they may not be as worried about it because they're not just reading the financial pages like me on a Sunday. But if they needed to, they would then be changing where the companies they invest in.
yeah, absolutely. And actually, it's interesting because in the UK, we've got a lot more of those kind of companies than anywhere else. We're quite old fashioned. We've got a lot of retailers. We've got a lot of utility companies, a lot of insurance companies. I mean, said to one investor yesterday, if your car insurance went up £20 a month tomorrow, are you going to suddenly say, I'm not having car insurance then? Unfortunately, you've got to. It's a legal requirement. So if that's affected by inflation, you bear the brunt of that, no one else. So, and we do a lot of insurance companies, like I said, utilities, and we're a nation of shopkeepers, so we've got a lot of retailers. But what you see there is those are almost quite defensive inflation scenarios. Defensively positioned inflation scenarios. So the UK market has gone through a period where it's had a rough time, and so we're seeing quite a few fund managers finding opportunities in the UK now at a time where prices are relatively low as well. Now, I'm not going to sit here and go, of course, everyone's going to have a diversified portfolio, but there are obvious fund manager trends towards the UK that we probably weren't seeing 2 years ago because of the level of uncertainty around. There is still uncertainty around, but the UK seems to have a lot of those kind of companies that people need regardless of the conditions they find themselves in.
Do you mind if I ask a quick question on that, Darren?
Yeah.
I mean, you've covered a fair bit. I was going to ask about the UK because predominantly a lot of our income portfolios, a lot of clients will be receiving dividends as a natural yield from their income portfolios. And yeah, we certainly understand with the pandemic that companies withdrew or significantly reduced their dividends. Yeah. And obviously with issues of Brexit and everything else which you've covered. Do you see a recovery in dividends? Do you see that actually starting to pick up again?
Yeah, I think we need to put some context on it though. We went in the UK. We went into the COVID crisis, if you will, in February last year, with a 5% yield. At that time, we paid double the dividend of anywhere else around the world. So no one else around the world had more than a 2.5% dividend yield. We were paying 5%. There were companies on the FTSE 100 borrowing at really low cash rates to pay a dividend to shareholders. So you're borrowing to give away a portion of your business every 6 months or 3, 6, 12 months, whatever that company would have done. That in hindsight is insanity. You don't repay, you don't borrow to just give your money away as a business. Now, where we are right now, traditionally, the biggest driver of dividend yield and the level of dividend yield would be where is cash and where is inflation. And then as a company management team, you position your yield marginally above cash and inflation so that your stock is attractive to shareholders because they'll make a real return on yield and more than they can get in a bank. That's a very simplistic way of looking at it. I know there's pharmaceutical companies and oil companies that pay 6, 7 regardless, just because that's what shareholders expect, but that's exactly why they pay it. It's because shareholders expect it. So if they reduce it to 4, their stock gets sold. Most company management teams have to gauge based on where cash and inflation is. Now, if we're told that inflation is 2.1 and cash is, let's say, 0.1, where's the incentive to get back to 5% dividend yields? Especially after an economic crisis where you'd probably be in defensive mode for quite a while. I just can't see how company management teams would do it. Can I see 2.5 to 3 by the end of the year? Yes. But I don't think you'd be pushing much more than that. You're certainly not going to get back into the 5s unless there's an incentive to do it. And the incentive to do it would be if inflation was getting to that point. So company management teams are very aware of those two. What can people get if they just put their money in the bank? What can they get in what do they need to get for inflation proofing their finances? And also, what are my competitors paying? BP and Shell don't get together and say we're going to pay a 7% yield. But if BP pays a 7% yield, you can be pretty sure Shell will. And it's constant. Standard Life pay 5. Well, Aviva are paying 5, then Legal & General are paying 5. And that's a constant cycle. That's sector specific. But on the market whole, I mean, I think was it 2.4 today? Actually, if you'd said to me 9 months ago it would be 2.4, I would have been surprised. So again, it shows you the progress that's being made. There are areas that haven't come back. There are areas that are fully back. Oil's back, pharmaceuticals are back. I mean, in yield terms, I don't mean in market terms. Insurance companies are back. Banks are still prevented by the FCA for paying full dividends. So Lloyd's, for example, wanted to pay a full dividend at the tail end of last year and was told by the FCA it couldn't. Legal and General wanted to and were told they couldn't because they were taking money from the furlough scheme. And the optics weren't quite good on that in terms of taking money off the government to then give out to shareholders. That's really not what you would want. So that got voted down by shareholders, strangely enough. But you see that individual companies are doing it, but the progress being made by the market is quite quick. So if we got into the threes within 6 months, I think we'd be doing pretty well. But I think the days of 5 with the current market conditions, I don't think that'll be a quick road back to those levels.
Okay.
So it's a long-winded way of saying no.
But the UK, we've seen some recovery anyway, which has been amazing, been fantastic for us, to see the UK coming back, and that it seems to be doing okay at the moment, doesn't it? That from what you see and what you read.
But yeah, I think it needs to be put into the context again of 5 years ago, the UK went through a massive change in. June 2016 was the referendum vote. That was the start of the uncertainty. If there's one thing markets don't like, it's uncertainty. Our market fall did not start because of COVID. Our market fall started on the 23rd of June 2016 when there was an unexpected result to the vote. Yeah. Now the market priced in the wrong outcome, so therefore it had to overshoot the other way. But ultimately, that's something that people have been challenging with the UK market for many years, which is, what does the other side of this look like? And I don't think that's been answered, which is why markets are still relatively compressed to where they were. I mean, if you think about the amount of money that central banks around the world have pumped into markets and pumped into their companies, that's why they're at all-time highs. Well, the UK's also done that, but we're not an all-time high. So something's holding our markets back, and it's Brexit, it's the whole uncertainty around politics and things like that. Now, other countries have that, of course they do. It just so happens we're one of the major markets in the world, so it gets more attention. Yeah. But then you had the COVID crisis. Then you had the largest case rates in the world for a short time. You've also now got with the exception of Israel and a couple of other places, the quickest vaccination program in the world, and the market has reacted well to that. So it works both ways. But our market is quite sensitive to good and bad news at the moment, whereas other markets seem to just carry on. Whereas ours seems to be quite. If the vaccination program works, if they open up on the 19th of July, you would expect the UK economy to have a good summer. Sure. But the problem being after that is, you need for the UK to thrive, it needs the global economy to also thrive. Yeah. And so we can only get so far on our own. We're 3.3% of the world's economy. We are an island, but we're not an economic one. We can do quite well this summer, and people will get out. Well, you'd expect people will get out. People will spend money. Leisure stocks, restaurants, pubs. These places, it's going to be better than last year because it can't be worse. But then what after that? And I think that's where you need the global vaccination program to be getting to speed with where we are, because that's where we want to import goods. We want and ultimately you need these things to be being made for us to buy them. Yeah. So this is where the vaccination program for me is the short term. It's a miracle. Over the long term, there's a massive challenge with how you get the world vaccinated.
No, I mean, morally and financially, it's an important thing to do, and luckily, Biden's on side now.
This is where the G7 announcement with
fantastic
1 billion doses is so important, because, I mean, look, I could tell you that it needs 5 billion, but ultimately 1 billion is a start, and that's it. It's about ramping up. It's about providing the finance to ramp up production, because if you ramp up production, they will go into people's arms. Yeah, and it's just a case of production. So the more finance that can be thrown at it, the better. The only people that can do that are the 7 richest countries in the world. So you've almost drive your. But let's not get ultra cynical about it. Those 7 countries know that they can't thrive on their own. So it is mutually beneficial to get this done. And if they've done it within a year of now, I mean, again, my wife's a science teacher. That's why the periodic table's behind me, by the way. My wife's a science teacher, and you know, she's always said to me, if this starts and ends within 2 years, that will be looked back on as a scientific miracle.
Yeah.
And that's where what we've got the potential of doing here. Nothing in history has ever come close to that.
Amazing.
And as investors, markets will benefit from that too.
Sure. And so, as always, our message is about time in and not timing. It's about spread. It's about spread of asset classes. So equity, properties, gilts and cash. It's about spreading our investments across the world, not just the UK, even though there is probably some potential here, but we always say spread everything and we look for the long term, and all of those things, even through this uncertainty and the things we've discussed, those still stand.
Absolutely. I think people often expect something major to happen in the world and that all of our views change at once, and it hasn't. And that's not that we're taking it lightly. It's that, like I said, it's our job to navigate through every risk. And if you're going to make you often make the same decisions through whatever that happens to get the best outcome. Because, like I said, if you're making emotional judgments based on last year, we were all going through turmoil in private lives, of course. But if that was being done on markets, you can see what could have happened to, you know, you've got out at the wrong time, you've gone back in at the wrong time, and it's just not. You need that consistent, level-headed approach, almost emotionless, which doesn't sound a positive thing, but is.
And those boffins behind you at head office, that's what they are. They're sort of clever, emotionless.
I wouldn't say that to their faces, but yes.
But they know what they're doing, and they know where to go and what to invest in next. That's the main thing, isn't it? So,
yeah.
Which we can be assured of. Has anyone else got any other questions? Anne, I'm sorry I missed. You were off my screen, so I didn't say hi, Anne. I'm really sorry about that. I hope everything's okay. If anyone's got any questions, otherwise I think we're looking to close. It's 5:02, and I know it's a lovely evening, so probably want to get out there with whatever your favourite tipple is and enjoy the rest of the sunshine. But thank you so much, everybody, for coming on.
Thank you for joining us.
Yeah, and Darren, thank you. Your wisdom and everything is just lovely to hear. And thank you so much for giving up your evening to speak to us.
Yeah, thank you, Darren. Very much appreciated.
Pleasure.
Very useful. Thank you.
If there's any questions afterwards that you get from anyone, forward them on to Robert and Richard, and I'll provide a written answer if you want.
Brilliant. Thank you so much.
Thank you very much.
Thank you, everyone. Have a lovely rest of your evening.
Thank you very much. Thanks. Nice to see you.
Bye-bye. Bye-bye.
Bye now.
Bye.
Yeah, thanks
Bye-bye.
very much indeed.
Bye, Anne. Bye,
Thank
Richard.
you.